On October 8, 1974, Franklin National Bank collapsed, the largest U.S. bank failure of its time. With $3.6 billion in assets and $1.4 billion in deposits, its fall shook the financial system. The culprit, massive foreign exchange losses and mismanagement. But that was just a prelude. 20 years later, another shock would hit, this time in the bond market, and it would be even more devastating. In 1994, the U.S. economy was recovering. The Federal Reserve under Alan Greenspan worried about inflation. On February 4, the Fed raised interest rates for the first time in 5 years. It was a small step, but it signaled the end of cheap money. Bond traders who had grown fat on low rates were caught off guard. The sell-off began. The bond market is a giant, and its moves are amplified by leverage. Investment banks and hedge funds borrowed heavily to buy bonds, assuming rates would stay low. When rates rose, bond prices fell. The losses were enormous. By the end of 1994, the bond market had lost over $1.5 trillion, a crash that rivaled the stock market crash of 1987. One man personified the era's hubris: Robert Citron, treasurer of Orange County, California. Citron managed a $20 billion investment pool for the county and other public entities. He used complex derivatives and borrowed money to bet that interest rates would stay low. His strategy had worked for years, earning high returns and making him a local hero. Citron's bets were leveraged and risky. He used reverse repurchase agreements and inverse floaters, instruments that gain when rates fall but lose big when rates rise. When the Fed started hiking, his portfolio bled. But Citron doubled down, believing rates would reverse. He even told investors that the risk was minimal. He was wrong. By late 1994, Orange County's losses were mounting. Citron's pool had lost over $1.6 billion, more than the county's annual budget. The county was on the verge of bankruptcy. On December 6, 1994, Orange County filed for Chapter 9 bankruptcy protection, the largest municipal bankruptcy in U.S. history at the time. The news sent shockwaves through the municipal bond market. The bankruptcy was a direct result of Citron's speculative strategy. He had used borrowed money to buy securities that amplified his bets. When rates rose, the losses were magnified. The county had to lay off workers, cut services, and sell assets to pay off its debts. Citron was later charged with fraud and pleaded guilty to 6 felony counts. But Orange County was not alone. Across the globe, bond investors suffered. In the U.S., the Federal Reserve's rate hikes caused a $1.5 trillion loss in the bond market. In Europe and Japan, bond markets also tumbled. The crash exposed the fragility of the global financial system, where leverage and derivatives had created hidden risks. The aftermath was painful. Many hedge funds collapsed, including Askin Capital Management, which lost over $600 million in March 1994. Investment banks like Kidder Peabody and Salomon Brothers reported huge losses. The derivatives market, once seen as a tool for managing risk, had become a source of systemic risk. Regulators began to scrutinize the industry. The Federal Reserve continued to raise rates throughout 1994, eventually hiking 7 times. The bond market did not stabilize until 1995, but the damage was done. The 1994 bond market massacre taught investors a harsh lesson. Interest rate risk is real, and leverage can turn a small move into a catastrophe. It also highlighted the dangers of relying on past performance. For Orange County, the recovery took years. The county had to issue new bonds to pay off its debts, and it imposed strict financial controls. Citron served time in prison. The bankruptcy led to new regulations for municipal investment pools, but the broader lesson was clear. Financial innovation can be dangerous when used irresponsibly. Today, the 1994 bond market massacre is a cautionary tale. It reminds us that markets can turn quickly and that leverage can amplify losses. The Federal Reserve's actions, while necessary to control inflation, had unintended consequences. The lesson for investors: understand the risks, avoid excessive leverage, and never assume that past returns will continue. The bond market's silence can be deadly.